You know, it would be really cool if the market would just flippin' crash already. That would be amazing. I've been holding on to this gigantic bleeding short position for such a long time. Most of you guys don't know what that's like. It's not fun, but I don't think I'm wrong. I just haven't been proven right yet. So most of you will disagree with me. You guys have been in my comments upset. I'm not the one causing it. I just see that it's there. The bubble is here and it's gonna pop. You guys have the mentality of this time is different. Fundamentals don't matter. The Fed's just gonna keep printing money. Do you know when they were saying fundamentals don't matter? At the peak of the dot-com bubble. Let me tell you, fundamentals do matter. This time is not different. It is just another bubble that will pop, and it's gonna be a big crash. You may not believe it now because we've just had a ridiculously long bull run since 2009. If you exclude COVID, that was like a month flash little recession. This has just been a super long bull run, the longest in our country's history. So it may seem like the stock market just goes up forever. Yes, over the long term, it keeps going up. But we have cyclicality. We have booms and busts. And we're getting closer to the end of this cycle. I believe it. Yes, I've been saying this for years, but I have learned a lot. Holding a massive bleeding short position for years will do that. The yield curve is following the pattern like normal. It's not broken. It's not over with. We're right on schedule. We are getting much closer. Valuations, the Shiller PE ratio, the Buffett indicator, they suggest we should see a massive decline. These things do matter. They do. The Buffett indicator isn't named after Warren Buffett for no reason. And the Buffett indicator just happens to be right around all-time highs. Higher than it was at the peak of the dot-com bubble when the NASDAQ crashed almost 80%. Higher than the peak of the housing bubble, 2007. The Shiller PE ratio was higher at the peak of the dot-com bubble. It was super concentrated to tech stocks. Right now, we are more broadly overpriced. Real estate and stocks overpriced. To me, this is not a scary thing. This is where opportunities arise. My dad started buying real estate in 2008 when nobody wanted to or was able to. He was telling everybody that would listen, buy real estate. 2008. That is when it starts raining gold after the crash. And I think we will see another opportunity. It's just been so long that it seems like it's just not going to happen again, but it will. I'm not suggesting that you guys enter a short position. It is risky. It can be very stressful. I don't recommend it. I think it will work out for me. I have long expirations. I positioned it in a way to allow myself to roll my expirations for a pretty low cost relative to my initial investments. This is not a short-term call. This is a long-term view right here. I'm not saying it's going to crash next week, next month, but it should start soon, maybe even this year. Usually takes a couple years or so, 1.5 to 3 years to get all the way to the bottom from the top. This one's gonna be a big one, so maybe closer to the 3-year end of that range. This is pretty much all I've been thinking about for the last few years. Feel like I'm going slightly crazy, a little bit. Not really, but everybody's going in the opposite direction as me, it feels. But look, I don't wanna be bearish forever. I'm just bearish when valuations are extreme like they are now. After the crash, if the market crashes like 60%, we see a Shiller PE ratio of like 16 or even less potentially, I'm telling you, I will be extremely bullish. And at that time, a lot of people, the majority, will probably be bearish. These things are notoriously difficult to predict. I've learned that the hard way, but I really think we are getting closer. So yeah, I think the S&P is going to crash about 60% from the peak. You might think that is just absolutely insane, but no, I don't think so. When you consider how extreme these valuations are, 60% doesn't even seem that crazy. 60% would get us roughly back to a median Shiller PE ratio of about 16. And that's not even factoring in any decline in earnings, which, you know, tends to happen during recessions. And that's assuming it just stops at the median. When recessions happen, when big crashes happen, it usually goes below the median, but we'll see. Yes, we will have stimulus. The Fed will stimulate. They will print money. They will lower interest rates. But guess what? They were cutting interest rates 2008. As the recession deepened more and more, they were cutting interest rates. It took them a while. They were dropping rates more and more and more. And as they were doing that, stock prices were going lower and lower and lower. It's not as simple as the Fed just starts cutting rates and everything goes back up. It may seem that way because it happened like that 2020, but they printed a ridiculous amount of money. They quintupled the money supply in a span of less than 2 years. I think that is very unlikely to happen again. I think they will stimulate. I think they will print money and they will lower interest rates. But I think we will still have the bubble pop and stock prices nominally going down a lot. Like, I get so many comments from you guys telling me I'm wrong. But after this market crashes, I'm gonna go back and look at those comments. And before you say, but AI is gonna change everything. AI is gonna be big. Yes, AI is gonna be big. It's already here. It's gonna keep improving. Yes. But do you know what else was big? The internet. We still had the NASDAQ crash almost 80%. And we are still heavily reliant on the internet today. Computers, it's still very big. So I think the same thing will happen. We'll still rely on AI in the future. It'll still be there, but we should still see a major crash in stock prices in the short term. Eventually they'll recover. Yes, it may take quite a while. It took about 13 years for the S&P to recover after the dot-com bubble burst. So if you're holding on to your shares, you might have to hold on for quite a while to get back to break even. I'm just simply observing it and betting a ridiculous amount of money on it crashing. So I guess we'll see how it plays out. I'm gonna keep on waiting like I have been for the past few years. It's not, it hasn't been extremely fun, but I'm in it and I'm gonna see it through.